Happy Friday. Hope you're having a great week. Checking in for a rates update. And, we had the 10-year Treasury note move below 4% yesterday and it remained there for most of the day today. As it stands right now, the T-bill is at 4.007%. But if the T-bill were to make a convincing move below 4%, that could usher in lower mortgage rates just based on the technical fact that 4% has been a floor of support for the 10-year T-bill for some time. So we're not there yet, but if we see continued improvement, extended multiple days in the threes, that could be very positive. Fed Chair Jerome Powell this week is talking about pulling back on quantitative tightening that the Fed has been engaged in over the last 4 years. Quantitative tightening is when the Fed is offloading debt from their balance sheet, and it's generally in the form of treasury bonds, mortgage-backed securities. So that puts supply into the bond market, which pushes bond rates higher. That is not good for mortgage rates because that then pushes mortgage rates higher. But the opposite is true. If the Fed's going to pull back on quantitative tightening, that can pave the way for lower bond rates and thus lower mortgage rates. Now, the reason the Fed is looking at that is we're seeing some regional banks now writing down large amounts of commercial debt. The commercial market has been struggling for several years, and if commercial mid-sized regional banks are going to write down large amounts of commercial debt, that can be devastating for a smaller regional bank. So that's something Wall Street has their eye on. Car repossessions at their highest level now since 2008. That is something to keep our eye on. And then we've seen weakening in the labor market over the last several months. So anything negative economically, that generally is supportive of lower mortgage rates. That's what we're seeing right now. So we'll see how the data continues to come out. But for right now, the trend is our friend. Hope you have a great weekend.